if you are investing in stocks and you are over 40, you are maybe doing something wrong. There is one mistake you should avoid, and in this video we will talk about this mistake. I will give you some actionable tips that can maybe help you improve your returns over time if you want to pick your own stocks, generate a lot of returns, outperform the market. Okay. In case this is your first video from this channel, welcome. My name is Christophe Nour and this is a channel for stock pickers, and the goal with this channel is to help you become a better investor. So let's start. The first point I want to talk about is that you're playing too safe. Some people over 40 years old think that you have to play safe when investing in stocks. Playing it too safe can keep you from smart growth opportunities. You still have time. I see plenty of people. Actually, I have on my website you can book a call with me, and I see people that are playing very safe and they are just keeping a lot of cash, investing sometimes in bonds or in safe stocks like Coca-Cola, PepsiCo, and they miss out on the gains. So their goal is to outperform the market, generate great gains, but their performance is not living to the expectation. Their performance is 4% per year. I mean, if you want 4% per year, just invest in bonds and that will be fine. That will do the work. So I see a lot of people making this mistake, and you think that you have to keep a lot of cash in case for your children, but you still have time. You still have time. I don't know, depending on your country, I don't know where the retirement age is. For us French investor, we have to work until we are something like 65 years old. So if you are 40 and you need 25 more years, maybe it's worth it to take a little bit more risk. You don't want to play safe, very safe, extremely safe in your portfolio, because you will miss out on great gains. And if your principal objective is to have great gains, invest and compound your money, you will miss out on great opportunities. And that doesn't mean that you have to do something crazy to outperform the market. It just means that you have to avoid playing extreme defense. You can play extreme defense if you are a risk-averse investor and you are not at 40 years old, but if you are 70 years old, yes, you can play safe. But before that, you still have time. You still have time. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The second point I want to talk about is sometimes some investors over-focus on safety, and that leads to lower returns over time. Again, this is not your priority. You have great stocks, great companies, slow companies, big mature companies like Nestle, PepsiCo, Coca-Cola, Procter & Gamble, big companies that have been there for decades and decades, if not centuries, and they give a dividends. And this is reassuring. A lot of investors over 40 make this mistake of prioritizing dividends and thinking that they don't have the time. They just want their 5% yield every year. So they invest in companies like Nestle, PepsiCo. The stock maybe is going down for some reason. If you look at the 10-year period, you have a lot of stocks like this, General Motors or GE, General Electric. The stocks do nothing for 10 years, but you give a comfortable 5% dividends. Verizon, AT&T, these kind of large conglomerates, but that will not give you a lot of money. You will not compound your wealth if you focus on these investments. Please check your portfolio, check if you have these big blue chip stocks, and if you are over 40, between 40 years old and 50 years old, I mean, I don't understand. You are missing out on great opportunities. It doesn't mean that you have to be very risky. It doesn't mean that you have to invest in the next IPO. You can just invest in better businesses that don't give dividends. They just reinvest in growth. You have plenty of opportunities. You can have, Facebook and Google are great examples, but maybe you're not familiar with these names. This is a little bit too tech for you, but you have other companies, great companies, about furniture, about the housing market, that grow over time, that deliver double-digit returns over time. They do 10% per year, 12% per year. Some do 15% per year, 20% per year. Anything can happen. But I'm telling you, if you focus on minimizing risks, being too safe. You will invest in these stocks, large stocks. They don't grow. You will do 3% per year. The stocks will go down over time. And if we have a recession for some reasons, these large stocks, they may suffer if they have thin margins. So you will make 3 or 4% per year. And this is not worth the stress. If you want 3 or 4% per year, just invest in bonds. And T-bills will do the work. So that's my point. If you want to play too safe, invest in bonds. You lock your returns, and that's fine. A balanced approach guided by a clear framework helps you select stock and manage risk. Yep, exactly. And this is what we preach on this YouTube channel. If you get conviction, you can build conviction with a clear framework. You can invest, how to select great stocks for the future. You can avoid these large stocks with dividends. You can focus on what matters in the long term. If you are 40 years old, you need to invest for 20 or 30 years. Okay, focus on what really matters. At the end of the day, stock prices follow earnings per share. Okay, so focus on earnings per share. How do you boost your earnings per share? You boost your net income, you reduce your net count, your net number of shares, and that's it. You have several analysis. I've made plenty of videos about it. It's just that easy. It's, I would say, no, it's simple, not easy, because sometimes you have to do the work, you have to check some metrics, and you have to hold and enjoy the ride. But yeah, I'm telling you, a clear framework to avoid these dividend stocks will give you more performance, a better performance, because if your priority is to compound your wealth, to double your wealth over the coming years, coming decades, if you want to multiply by 3, by 4 your wealth, you will lose patience if you focus on Nestle and PepsiCo. You will have some stress, you will have fear of missing out, FOMO, and you can do wrong things, many mistakes like this. And that's basically it for this video. If you are over 40, it doesn't mean that you have to play very safe. You can play reasonably safe, but I'm telling you, if you invest in PepsiCo or Nestle or some bad railroads companies like oil and gas companies, all the companies, you will not have the returns you expect. I'm telling you, this is a risk. Not a lot of people think about this. Maybe the best opportunity you can have is to take a little bit more risk when it comes to growth in the future, because you still have time. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.